Hey everybody, Tim Albrecht here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week, I welcome back onto the show Tony Umholtz, a mortgage loan officer with First Horizon Bank. During the show, I tap into Tony's 20 plus years of experience in the industry to get his input on current trends in the housing market, what makes this cycle different than 2008, 2009, his take on the connection between presidential election years and interest rates, and what prospective homebuyers can be doing right now to get ready for buying a home in 2024. Okay, let's hear from today's sponsor, First Horizon, and then we'll jump into my interview with Tony Umholtz. Does saving 20% for a down payment on a home feel like an uphill battle? It's no secret that pharmacists have a lot of competing financial priorities, including high student loan debt, meaning that saving 20% for a down payment on a home may take years. We've been on a hunt for a solution for pharmacists that are ready to purchase a home loan with a lower down payment and are happy to have found that option with First Horizon. First Horizon offers a professional home loan option, aka doctor or pharmacist home loan, that requires a 3% down payment for a single family home or townhome for first-time home buyers, has no PMI, and offers a 30-year fixed rate mortgage on home loans up to $726,200. The pharmacist home loan is available in all states except Alaska and Hawaii and can be used to purchase condos as well. However, rates may be higher and a condo review has to be completed. To check out the requirements for First Horizon's pharmacist home loan and to start the pre-approval process, visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. Tony, welcome back to the show.
Hey, thanks for having me, Tim. Good to be here.
Excited for this conversation. We're going to pick your brain, tap into your expertise, Tony, on what you're seeing in terms of current market trends. We'll talk about what may be ahead in 2024, especially for those that are making the decision or want to make the decision to buy a home early in 2024. And then we'll wrap up by talking about the pharmacist home loan option as one option that pharmacists may consider as they're looking at some lending solutions for buying a home. Let's talk about current market trends. I think every time we've talked on the show in the last year or two, we've said something along the lines of, hey, this is a crazy market. This is a weird market. And here we are, end of 23. It seems like interest rates are starting to stabilize a little bit, but we're heading into a new year, obviously market volatility. We're going into a presidential election year. What are you seeing right now, Tony, as your boots on the ground working with many other pharmacists and healthcare professionals that are looking to buy a home?
You know, it truly is a unique year in a lot of ways. I know we've said that before. And the one thing about mortgage industry and the real estate industry is it's ever changing. It's constantly changing, and you got to constantly adapt in our industry. It's constantly evolving. Some things that are just truly unique right now is obviously interest rates, how quickly they've risen. I think it's the fastest they've risen since the 70s. And they definitely are meeting some resistance now. You know, it's not to say they can't keep climbing higher, but we've seen a little bit of a pullback here recently, primarily based on the consumer price index numbers, which have been slowly coming down. But we're getting to that threshold where lenders, like in the lending world, when we look to sell a loan, right, to Fannie, Freddie, or to some dealer or investor, they don't see rates going any higher. So they're not paying a premium for higher coupons, which are rates. So you can kind of see that we're kind of getting towards the top here. But it's just a truly unique time. And I think there's other headwinds here. You know, I don't want to dive too deep yet, but like we got to be careful because we may not be out of the woods. I mean, the fiscal stability of the U.S. is another thing we really have to watch, because bonds could be priced, government debt and rates could be priced based on the solvency of the U.S. government and the debt ceiling. Getting through these debt ceilings and the debt ballooning like it is could be a pressure on rates in the future.
Yeah, one of the things I love, Tony, about your perspective when you come on the show is just giving us some of the macroeconomic considerations of what's happening. And there's what we know now, and then there's what may or may not happen into the future.
Right.
One of the things I wanted to ask you about is knowing the experience you have, 20 plus years in the industry, knowing you've lived through some of the cycles that we've seen. 08, 09 is the one that kind of jumps out to me, that was a very challenging, season for many. Obviously, we saw the impact on real estate. We saw the impact in terms of foreclosures that happened in that period. What makes this cycle different than what you saw back in 08, 09?
So in 08, 09, it was such a challenging time because, and I got into the business right after the 9/11 pullback. So it was a little bit of a recession there too. But the 08, 09 was just devastating, right? Especially in the Southeast in Florida, where I'm located. And we saw some property values get cut in half. But the dynamics were completely different than they are today. I mean, we had an oversupply, overbuilding of homes. We had mass speculation. In the run up to that, you had clients that could get as many mortgages as they wanted
Mm-hmm.
based upon a credit score. There was no fundamentals. There wasn't a debt to income ratio. So there was mass speculation, people building homes based on credit, may not have had even down payments. So it was just it was a completely a bubble driven by, both speculation and easy money, right? So when 08 and 09 came and the crash came, we still were very busy. There was lots of inventory. Now, granted, a lot of the transactions were short sales. Lots of people wanted to refinance because rates started
Yeah.
falling in the recession. But the challenge was a lot of folks would have to come to the table with money to
Yeah.
refinance because the loan to values didn't change. And the market corrected like that. The government came in and put different policies in place,
Mm-hmm.
but it was amazing how the market corrected.
Yep.
Investors would not buy certain things. It happened very, very quickly. And then, of course, the regulations stepped up. So the regulations that were put in place post 08 and 09 have really helped now it made lending very tough and buying a home very difficult,
Yep.
but it's loosened some since then, but not a lot. So you still have to show a very tight debt to income ratio. Credit scores are important. All these things are important in buying a home. So it's made the credit side of the housing market much more healthy. So now we basically had from 2010 to 2000 to 2020 and even 2021, we were underbuilt as a nation. Like our
Mm-hmm.
population was growing, but we weren't building enough homes to keep up with that. I mean,
Yeah.
so many builders went out of business in that time frame. I knew really good builders who had been in business for decades before that, pretty much shut down for a number of years before they reemerged. So we were underbuilt all those years. So
Yeah.
now we're in this situation where we don't have enough inventory, right? We have more demand for housing. So this crisis is different in a lot of ways. It's more of an interest rate driven crisis, right? It's driven by interest rates being high and not enough inventory. So those are the two issues we run into today. So every market is different, right? Every challenge is
Yeah.
different. And that past cycle in 08 and 09 was a just a irrational exuberance in lending, right? And then in construction, it was crazy. Everyone was just building to build. There was investors lined up. I remember clients coming to me, Tim, saying, I just got my name picked in the lottery. And basically all they were going to do is flip that house. They were
Mm-hmm.
going to put their number in and they were going to flip the house when it was done. And I can't count how many of them did that. There was
Yep.
so many of them that did that. And a lot of them got burned at the end, right? They got in there, the home finally was built, and then the property values, fell.
Yeah.
Now they did come back over time. Now we're in a situation where we just don't have enough inventory, and that's the biggest
Yeah.
challenge now, and the affordability with rates being high, and the
Yeah.
combination.
I was just thinking about affordability, Tony, as you were talking, thinking about many of our listeners, especially those that are on the front end of the career, maybe first-time home buyers. It's a totally different world out there, than I graduated in 2008. And, I think about today's graduate, we now have student loans that are, turned back on after a 3+ year, freeze on interest rates and payments. If they have other fixed expense like car notes and payments, obviously interest rates have gone up. And now we look at what's happening in mortgage rates, not just on the interest rate, but also in terms of the home prices and appreciation. And so what you could buy, if you think about it in terms of a monthly payment, which is what a lot of people are looking at in the context of the budget, what you could buy 3, 4, 5 years ago, very different, in terms of what you can buy today. And especially when you factor in not only is the monthly payment only going to go so far, but obviously home prices have gone up in that period as well. And what I'm hearing a lot of anecdotally, Tony, is people that are looking at their interest rate and saying, whether it was those that were first-time home buyers over the last decade that maybe they thought this was their starter home, and now they're looking at it saying, I ain't moving. I'm not trading my 3% rate for an 8% rate. And so they're kind of staying in the home longer. Maybe they're spending more of their money on remodeling the home and doing other projects or spending it elsewhere instead of moving. And then those that maybe are in that phase where they're nearing retirement, maybe thinking about, downsizing, going from a two-story to a one-story home, and they're looking at the same thing. Like, if we don't have to, can we wait so that we don't trade our 3% rate, for an 8% rate? And I think that's obviously furthering the issues around supply.
Absolutely. Absolutely. There's no doubt about it. There's a lot of pent up demand. I mean, we all feel it, right? There's,
Yeah.
families are growing, right? There's more additions to the family. People, even extended family moving in. All these things are happening now, Tim, and it's pent up, right?
Yeah.
So, in talking to a couple veteran real estate agents that I know that have been in the industry 20 plus years, their thoughts to me were, you can get a better deal on a house right now. Yeah, it's expensive, but you're going to get a much better deal on a home right now in the current climate. And most people see rates going down in the
Yeah.
future. Refinancing, your affordability comes back.
Yeah.
I do. It's definitely a very, very challenging time. Obviously, I mean, the one thing that I would say, I don't want to discredit the student loans and everything that's going on, but just looking back at the 08, 09, 2010 crisis, the job market was not near as healthy as it is now.
Yes. Hmm.
So we all have to remember that, like, we look back at history and we think we may have it so tough,
Hmm.
but I always look back and, my gosh, my dad had it way tougher than me. When my grandfather was alive and I'd speak to him about what he went through,
Yes.
perspective hit home, working 3 jobs, all the things he did. It was just a different time. Yes, things were cheaper, but wages weren't where they were.
That's
The
right.
opportunities weren't where they were. So, we look back and I look at 08, 09, and the job market was not near as
Yeah.
healthy as it is today. So
Yeah.
there's much more opportunity for people right now. It's an overabundance of opportunity to be employed, but the costs are higher, right? And part of that's inflationary. Part of that
Yeah.
was, we don't want to get into all the details, but there certainly is an issue with the cost. And I do think you'll see slowly the rates come back to normal. Rates should not be this high. They should be, it should be 5 to 6% on a 30 year. It's probably where
Hmm.
they should be,
Yeah.
right? That changes a lot of numbers from in the sevens. I
Yeah.
mean, it changes things quickly.
Let's talk about that for a moment, Tony, because you said something earlier about pent up demand. And when you're talking here about 5, 6% rates, if, which is a big if, but if we see that transition happening, that pent up demand, right, there's going to be an explosion of buyers into the market, which further challenges the supply and demand issue. And so, I think as we were talking offline before we hit record, I think the tendency, especially of a first time home buyer in this type of market, is to say, wait. And, I want to wait for prices to come down. I want to wait for interest rates to come down. And obviously someone's got to be ready to buy. We don't want someone to go down that pathway before they're financially ready. However, like, does that potential waiting mean there's more people that are flooding into the space? And so maybe rates do come down, but now you've got more competition in the market and you pay more for the home. So I think there's an interesting balance here. And I just want to get your thoughts on, like, might there be a place to buy now? And even if rates come down, then there's an opportunity maybe to refinance in the future.
Well, I think that's exactly what I'm hearing from some of the real estate agents that I know is that as soon as, I mean, they all have a lot of buyers that are on the sidelines that they represent, and they sense it as soon as rates come down to a little bit more meaningful level, they're all going to want to come back in. So what does that do? That just
Yeah.
creates a lot of competition. So in the areas where you've seen a little bit of a buildup in listings, it's a good opportunity to get a much better deal on the home. Now, I will say with this though, you don't just buy to buy. You buy
Yeah.
if you find a home that suits your family and your needs. I always say if you're going to be in a city for 5 years, it makes sense to buy, right? It always makes sense to buy versus rent. But if you're only going to be there for a transitory period, then it probably doesn't make sense. You want to just continue to rent. But rental costs are likely not falling much, if at all.
Mhm.
Probably will go the other way. So, the cost of renting versus owning over time will be more. I would just say, just from what's been, shared with me, is it's going to get a lot more competition quickly
Yeah.
if you wait. And I do think we'll see rates fall. I don't know how quickly or when, but you can just see it. You can kind of already see it in the market. I don't want to call it top, but I told a couple of my friends that are CFAs, which are certified financial analysts, I said, watch the 5% on the 10-year treasury will likely be a peak. And so far I'm right. I don't know. They go, no, it's not, Tony. It may not be, this and that. And
Yeah.
one of them said, you might be right, because they've rallied down, the 10
Yeah.
years down to 4.5 now. But I think just the economy can only take so much, right?
Yeah.
And I think that's the issue. And I think we're getting to that point. And if you can afford it now, you'll get a better deal if it's the right home, right? And then I think you're going to be able to lower the cost of ownership later. I really do.
One of the things I want to get your perspective on is I'm already seeing rumblings out there on social media and the news about, the connection between a presidential election year and what historically has happened in the economy. Here we're talking more specifically around mortgage interest rates. And again, disclaimer, we're not trying to predict what may or may not happen, but I do think it's just an important piece of information as we head into 2024, which is a presidential election year. Give us your insights, Tony, of what you've seen in previous election cycles.
You can't go in saying it's going to happen, right? That rates are going to happen. There's a couple of things that I've seen, and nothing's a guarantee, but it's typically a rocky year for the stock market in an election cycle, right? So stocks are usually volatile, typically on the downside.
In case we haven't had enough of that lately, right?
Yeah, right. We haven't had enough of that. But crazy enough, the S&P is up this year primarily because of big tech names. If you equal weighted the S&P, it's not doing well, but on a relative basis, it's up because of those big tech names. But typically, the stock market does not do well in an election year. So what does that mean? That means bonds usually rally, right? Because money flows. Although we've seen bonds and stocks more correlated than ever this year, but typically that's what it represents. The other piece is just the uncertainty. People rally to bonds. There are some people that say, I don't necessarily believe this, but they say, hey, there's political pressure by the incumbent party to get rates to come down. I don't necessarily believe that, but some do. So typically you will find that rates will, normalize or get a little better in an election year on average. If you go back through history, it typically does. I don't think we're going to see a huge rally, but we could, could. I mean, it's interesting. UBS, some of the big brokerage firms are actually calling for, I think UBS calls for 275 basis points in Fed cuts by next fall. That's huge. I would never predict it. I mean, I think Morgan Stanley and Goldman are calling for maybe not that high, but close. So my personal feelings are the Fed is going to wait till the job's done. I just think they're going to do it. They're going to stick by their mandate and make sure inflation gets down. And it's going in the right direction. It's the last report was 3.2%. So I think if that continues. And then the other thing is economic decline. We just got to watch the job market, the health of the economy. Walmart had some comments this morning in their earnings, and the stock was really getting hit. And it's around consumer spending, right? So if we start seeing these things decline, that's going to be a deflationary signal, and that will cause rates to decline.
Yeah. The last thing I wanted to get your insights on as we're talking about current market trends here, and something you brought up in our discussion as we were preparing for this episode, is what you're seeing out there in terms of consolidation of lenders, which makes sense, right? It's been a challenging market. It's been a challenging period. And is this a space where, kind of the top are getting stronger and the weaker are falling out? But I think that's important to discuss as people are making a decision of who they're working with as a lender, just to understand what the landscape is and what's going on right now. So give us a quick recap of what you're seeing of consolidation of lenders and what trends we may expect going into the new year.
Yeah, sure. I mean, just to be very transparent on the mortgage industry, it's a very, very low margin business. At the end of the day, it's a huge transaction for individuals, but with all the costs involved in origination and the way the secondary markets and the hedging work, it's a super low margin business. It really is one that has to be done on volume and units. And a lot of lenders are really struggling right now. And where most lenders that have what's called a servicing book, that means they're servicing loans, that can show some profitability. I will say even some really big lenders are in jeopardy right now, like really big names, possibly even publicly traded. It's not an easy industry with these margins. And A lot of consolidations going on in the independent mortgage bank. And I don't want to get too technical for the audience, but I just think it's always good to be transparent as possible. So independent mortgage banks are non-bank originators, and there's been a lot of consolidation in those groups. So they're acquiring the ones, and sometimes it's fire sale, right? Because they're losing so much money that they're just being gobbled up for their assets and their technology and their people, basically more or less their people.
Yeah.
And you're seeing a lot of that right now. I think it's going to get worse over the next 60 days, though. It's going to get real magnified here. I'm hearing about it. There's some wholesale lenders that are closing up access, but that's more for the broker community. So if you're a mortgage broker and you've got a couple lenders you broker to, you're seeing more wholesalers go wholesale side lenders that are pulling out of the business. Like I noticed that a big one was pulling out. They won't take applications after December 6th. So some of that stuff's happening. So, and it can affect people. I mean, I've had people tell me in past cycles that the funding stopped. My loan was approved and now they don't have a loan. And so I wouldn't frighten a lot of folks. I think most lenders are going to be okay, but there are going to be some that don't make it, and it's hard to predict because the originators themselves don't know really what's going on. Like I said, it's such a low margin business that the folks operating it, running it, don't always share with their sales force what's happening.
Yeah.
But I think you will see continued consolidation and probably some big names that maybe merge, to hide the failure. That's usually what happens. These two are merging. Well, there's a reason, right, that they're merging. So it's going to be, unfortunately, it's been a tough time.
So with that uplifting message about the current market trends and where we're at, let's shift gears and talk about how someone can get themselves ready to buy a home in 2024, obviously thinking about the spring season. And if we do see those rate reductions, we're talking about obviously the pent-up demand coming into play. And I think it's something, I know, Tony, we've talked about this on the show, but just from my own personal experience, we often think this is a longer term decision and then it just starts going really quickly, right? I mean, just human behavior is, especially for a first time home buyer, wanting to get in a home and I'm going to, have all my ducks in a row and we're going to do this in, March or April 2024. And then all of a sudden you get onto Zillow, you get into Redfin, you drive by some properties. Next day you're talking to a lender, you're working with a realtor, and all of a sudden you got an offer that's in, right? So these things can move quicker. And I think anything that folks can be doing to prepare and to put themselves in a good position to come with a competitive offer, to have a strong lending application, this is the time as we wrap up 2023 to be thinking about that. So from your perspective as a mortgage loan officer, what are some of those key things that individuals should be listening for, especially the first-time home buyer maybe hasn't gone through this process, to make sure that they've got a good financial house in order as they look at seriously purchasing a home?
Sure. I mean, I think the first thing, just make sure you have margin in your life, right? What I mean by that is how much are you paying in debts? What's your income coming in every month, right? Create that margin, your budget, right? What do I want to spend on housing and this property, right? I think creating that is important. Obviously, paying debts down, keeping your liabilities to a minimum is important. The other thing is just looking at your credit score, making sure your credit score is where you need to be. I think for a lot of folks, especially first-time home buyers, it's the revolving credit, right? It's the credit cards and that balance on their credit card compared to their utilization, right? So like if they have a $10,000 cap on their spending, right? A $10,000 limit, and they run it up to 9,000, that's going to hurt their credit score. So keeping that down, that ratio down at 50% or below, I find is the best. So if you can keep it down there, that's going to help your credit score. Just making sure overall you're on strong footing financially, I think is the right thing to do. Having some savings for a down payment if you choose to. We're obviously going to provide the best we would, and any lender, most lenders should, would provide clarity as to the best options for you as an individual, whether it's a low down payment option or one with more down payments. You got to think through that. Do I want to have 20% to put down or 3%? Am I eligible for 3%? So savings is important. Start creating that savings, right? That savings piece. You have to have enough for closing costs as well. There could be, depending on the timing of this and what state you're in, and I don't want to touch on this too much now because it's very much preliminary, but there was a big ruling on real estate commissions through the
I
NAR.
just saw that.
And it could change. I don't want to get too, because could be some back and forth with this.
Supreme Court decision, right? That happened.
That's right. That's right. But I
Yeah.
think two states have already accepted it.
Oh,
And
really?
I think Missouri and New York, I think, are implementing it, and we just got to watch how buyer commissions are
Yeah.
impacted. I think overall, it's going to bring. I mean, my opinion, if this goes through, I think it's going to bring the costs of commissions down tremendously for the end user. So selling a home will be cheaper than it's been in the past. But my concern is underrepresentation of buyers,
Buyers. Yep.
because they're going to be going straight to the listing agent. They're not going to understand the schools, the area. They're not
Yes.
going to have the representation. That's my concern. And I also think it's going to cut maybe 30% of the realtors out of the business immediately. So
Mhm.
it's going to be a huge different changes in that portion. I think ultimately it'll save people money, but it could underrepresent, and provide less service to people. So that could create an additional expense for some buyers in some areas, that they may have to pay their agent something, that's typically coming out of the sales price now.
Tony, for those that have not been following the details of this decision, we're going to talk about more on the podcast in the future, but I think what you're saying is a really important point about potentially the underrepresentation of buyers as this shakes out. Just explain more about why that may happen.
Well, if the real estate industry adapts where you have to basically pay a buyer's agent to represent you directly, it might be tough for a lot of people to do that,
Yeah.
right? Even though you're ultimately going to save the money on the home purchase because the seller doesn't have to pay 6%, they're paying 3%. You're basically paying whatever portion difference. I don't know what it's going to be in that area, but let's say it's 3%.
Yeah.
So if you're paying 3%, it seems like a lot, right? $200,000 home, it's $6,000.
Yeah.
So if you're coming out of pocket with that, that's additional expense. Sure, there's maybe a way we can roll it into the price somehow, seller concessions, things like that, but there's additional costs. So I think a lot of people will say, I don't need that. I'm going to go right to, I found this home on Redfin, or I found it on Zillow, I found it online. I'm going to go right to this
The
house.
seller. Yeah.
Well,
Mm-hmm.
the seller's agent, listing agent, represents the seller, right?
Mm-hmm.
So they may not give you all the details on the area, the property. Is it the right school system for your kids? Is it the right area? I mean, I just think there's going to be an underrepresentation for some buyers in certain areas
Yeah.
if they don't engage that buyer's agent. Just over the years, that's what I've seen the value is those agents do provide clarity and help on what's the best area. I mean, there is value there, and I think some people may give that up,
Yeah.
right? So it's just that's the concern I have when initially reading through the ruling.
Great insights. And again, that's evolving as a story and new news to me. I hadn't heard about the couple states that already adopted it. So we'll keep an eye on this and make sure we're sharing information as we have it. Last thing I want to ask you here, Tony, about someone getting themselves ready for 2024 would be about the pre-approval process. So, if I'm listening to this and it's end of 2023 and I'm thinking about buying a home, let's say in March, April, sometime in the spring, what recommendation would you have in terms of when they should be thinking about starting that pre-approval process?
Well, I think just what we touched on earlier, Tim, about making sure your margins and your
Yeah.
budget, starting to plan now. For some people, it might make sense to actually engage a lender now, just because if you're talking about closing in March, April, or May, it's coming faster than you think because you're going to start looking at homes. You want to know you're eligible for
Mm-hmm.
these houses. The other thing is you may want to be under contract for 60 days. One thing I've always said, if someone has their house listed during the holidays, they are a serious seller, right?
Mm-hmm.
They want to sell that house. If they're having people through the house with their family and ornaments up and all that, they're serious and they'll probably negotiate more.
Mm-hmm.
So like it can be a good time to pick up a deal usually versus the spring when there's more people. But let's just say you're waiting and you may want to get pre-approved now if you go under contract at the end of January, right? Or sometime in February and it's a 60-day close or 45-day
Mm-hmm.
close. So your timeline, I think depends on when you're looking. Like if it's in the summer or May or June, then maybe you wait until after the new year to get an actual pre-approval. But it's never too early, in my opinion, especially if you might have a credit issue
Yeah.
because lenders have ways to like we have a system where we can run simulations of what their credit could be they pay certain things off. And that's
Mm-hmm.
been really valuable, not only in getting people approved, but also in getting them better interest rates and better programs. Getting someone from maybe 660 credit score to a 700
Yeah.
or 700 to 740. And it adds a lot of value. And I think it can take some time. So that's where I think pre-approvals are important to get ahead of it.
Let's wrap up here by talking about the importance of knowing your lending options. Specifically, I want to talk about the pharmacist home loan product that you all offer at First Horizon. And we talked about on a previous episode, 285, which was cracking the code on home buying loan options. We'll link to that in the show notes. We covered the variety of options that are out there, from FHA to VA to conventional to the pharmacist home loan. And one of the things you already said, I think, is a really important point to reiterate, which is, when working with a lender, ideally they're helping you kind of understand what those different options are to see, based on interest rates, based on your credit score, based on cash available, what's the loan option that makes the most sense for you. So it might be, for some, it's an FHA loan and they're not thinking that that would be the best option, or it might be a conventional, or perhaps it is the pharmacist home loan product. So tell us about that offering through First Horizon. I think many people, if this is new terminology, they might have heard of doctor loans that are out there, and many of those lenders may exclude pharmacists, or they might be available in certain states. One of the reasons we've been partnering with you guys for 4+ years now is the national reach, right? And we know we've got a national audience that's out there. So who is this product for, and what is the makeup of the product?
Sure. So the product that we offer to pharmacists, of course, you have to be a practicing pharmacist. You have to have be in the field and be actively working in the field to be eligible. The program really, it's not just for first-time home buyers. This could be your third or fourth home.
Mm-hmm.
It just changes with the down payment.
Yep.
So like if you're a first-time home buyer, I know we've discussed this in the past, but I'll repeat it, but it's 3% down if you're a first-time home buyer. It's 5% down if you've owned a home in the
Mm-hmm.
past. So those would be the two differences. There is no mortgage insurance. So that's a really big benefit. We really do not have a reserve requirement either, which is fairly significant as well. There's a minimum credit score of 700 on the product. Obviously, the advantages are not putting a lot of money down into the house and, having no MI,
Mm-hmm.
I think is the big advantage, right? And, we've had a lot of folks who, especially over the last 4 years, who have taken advantage of this loan and put 3 or 5% down. And obviously the values of homes have gone up, and they've really been able to get a great investment in their money, right? Get great return on their money. So it's been a really good program. But like we mentioned earlier about the market constantly changing, the mortgage market evolving, the secondary market and how things have worked with trading, it was interesting for some clients that their credit scores may not be really, really high,
Mm-hmm.
but still good enough for the pharmacist product. Sometimes FHA loans have been unbelievably good. Like the margin was so much better on the 30-year fixed pricing. We've been able to offer that. And that wasn't the case 2 years ago or a year ago. It's like, so we try to just look at what the market's offering us, because, sometimes these other programs can be better if the rate is significantly lower. So anyway, that would be, how we look at things. Obviously the pharmacist product's the first thing we look at. If you're a pharmacist, it's the first thing we're going to look at, but we will compare. Everyone's situation is unique. And that's why we'll look at, other options too. There's plenty of other options that we carry.
And the maximum loan amount on that right now is what, Tony?
It's $726,200, but I believe I'm about 90% certain after Thanksgiving, traditionally this will come through, but I think we'll be at 750 or a little higher by next year. I'm pretty certain it'll happen. That'll be the max loan amount. So that's the max the loan amount can go to.
Okay.
We'll
wait to update the website. So we'll leave it for now.
I would wait. But you think about that in the spring, if someone's looking to buy next year, potentially you could buy an $800,000 home with 50,000 down, or less.
Yeah.
And that's pretty good with no MI. So that's going to be on the table here, pretty soon, I think.
So just to recap the highlights, and we've got more information on the website. If you go to yourfinancialpharmacist.com/home-loan, we'll link to that in the show notes as well. You can see all this information and some additional resources, but 3% down for first-time home buyers, 5% down if it's not a first-time home buyer, no mortgage insurance, 30-year fixed rate option, maximum loan amount of $726,200, potentially going up. and a minimum credit score of 700, available nationwide except in Alaska and Hawaii. So great option for folks to be considering. And again, the point you're making is such a good one that, when working with a lender, you want to feel confident that they are looking at all the options, that are out there. And so, you've highlighted well that can change, will change based on what's happening, in the economy and with the different products that are available. So Tony, as always, this has been awesome. Really appreciate your insights for our community. And folks want to get connected with you and again, learn more about that offering, yourfinancialpharmacist.com/home-loan. You can click on get started and that will provide a quick questionnaire and then we'll get you in touch with Tony and his team. So Tony, thanks so much.
Hey, thanks, Tim. It's great being here with you.
Absolutely. Happy Thanksgiving. Take care.
You too.
Before we wrap up today's show, I want to again thank this week's sponsor of the Your Financial Pharmacist podcast, First Horizon. We're glad to have found a solution for pharmacists that are unable to save 20% for a down payment on a home. A lot of pharmacists and the YFP community have taken advantage of First Horizon's Pharmacist Home Loan, which requires a 3% down payment for a single-family home or townhome for first-time home buyers and has no PMI on a 30-year fixed-rate mortgage. To learn more about the requirements for First Horizon's Pharmacist Home Loan and to get started with the pre-approval process, you can visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of Your Financial Pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.